Hey everyone, welcome back to Corporate Dakota, the place where we peel back the layers of corporate jargon to see what is really going on behind those big numbers. Today we are diving headfirst into Range Resources, Corporation's latest 10Q filing, and let me tell you there are some eye-opening shifts happening in their finances. Get ready because we are about to decode the story hidden within their latest quarterly report and understand what it means for you. Before we dig in, if you are looking for clear, straightforward explanations of complex financial reports and want to stay ahead of the curve on industry trends, make sure to smash that subscribe button. And hey, if you want to chat more about these filings and join a community that loves breaking down corporate news, check out our Discord server linked right down in the description below. Now let's talk about Range Resources and where they stand financially. This is a look at their performance for the third quarter ending the 30th of September 2025. It is their quarterly report, which means we get to see how they have been doing over the last 3 months. Let us start with the balance sheet, which gives us a snapshot of the company's financial health at a specific point in time. As of the 30th of September 2025, their total assets stood at a hefty $7.2 billion. That is a lot of value, but it is also down slightly from $7.3 billion at the end of 2024. Now, one of the first things we always look at is cash. And here is a bit of a shocker. Their cash and cash equivalents at the end of September 2025 were only $175,000. That is a massive drop from over $304 million at the end of 2024. Now that might sound alarming, but sometimes companies strategically use their cash to pay down debt or make large investments, so we need to see the full picture. On the liabilities side, their accounts payable were about $139 million in September 2025. That is a pretty standard number showing they are managing their short-term debts to suppliers. Their total current liabilities, which are obligations due within a year, were $595 million in September 2025. This is a significant decrease from over $1.2 billion at the end of 2024. This usually means they have managed to pay down a good chunk of their short-term debts, which is generally a positive sign. And finally, the bottom line on the balance sheet, their total stockholders' equity, which represents the owner's stake in the company, rose to about $4.2 billion in September 2025, up from $3.9 billion at the end of 2024. This increase suggests the company is growing its net worth. Now let us move to the income statement to see how profitable the company has been. For the 3 months ending the 30th of September 2025, they reported revenues of $748 million. That is a nice jump from $615 million in the same period last year. The biggest driver of this revenue increase is sales of natural gas, NGLs, and oil, which jumped to over $611 million compared to about $533 million in the previous year's third quarter. So their core business is bringing in more money. They also saw a significant increase in derivative fair value income, rising to $92 million from $47 million. This can be a bit of a double-edged sword, as it means their hedging strategies are creating large paper gains in this period, but could also mean large paper losses if prices move unfavorably later. On the cost side, their total costs and expenses were $565 million in the third quarter of 2025. This is up from $548 million in the same period of 2024. But importantly, costs did not rise as fast as revenues. That is a good sign for profitability. The result of all this is a healthy net income of $144 million for the third quarter of 2025. That is nearly triple the $50 million they earned in the same quarter last year. This is a really strong performance. Looking at the first 9 months of 2025, the picture is even brighter. Total revenues reached $2.3 billion, a big jump from $1.8 billion in the same period of 2024. Their net income for these 9 months was a whopping $478 million compared to just $171 million in the prior year. This shows a consistent upward trend throughout the year, and for shareholders that means diluted earnings per S-share were 60 cents in the third quarter compared to 21 cents last year. For the first 9 months, earnings per S-share were $1.99, up from 70 cents in 2024. This indicates a significant increase in value per S-share. Now let us look at the cash flow statement. This tells us how much actual cash the company is generating and using. For the first 9 months of 2025, Range Resources generated a substantial $913 million in cash from its operations. That is a healthy increase from $726 million in the same period of 2024. More cash from operations means they have more flexibility to invest in the business or return money to shareholders. On the investing side, they spent $433 million on adding to their natural gas properties in the first 9 months of 2025. This is a massive investment in their future production capacity. Financing activities show some interesting movements. They repaid $608 million on their senior notes in the first 9 months of 2025 and also borrowed $885 million on their credit facility. This suggests some debt restructuring, possibly paying off older notes with newer borrowings. They also spent $176 million on repurchasing their own stock. This is a common way for companies to return value to shareholders when they believe their stock is undervalued. Looking at their debt structure details, we see that as of the 30th of September 2025, they had $129 million outstanding on their bank credit facility. Interestingly, on the 2nd of October 2025, they actually entered into a new amended credit facility, which matures in 2030 and increased their available credit capacity. This shows they are proactively managing their financing. A key item here is that their 4.875% senior notes due 2025 were paid off in May 2025. This is a significant debt reduction and likely improved their financial flexibility. Now, for something a bit more technical but important for an energy company, asset retirement obligations relate to the future costs of plugging wells and dismantling facilities. Their total asset retirement obligations were about $141 million at the end of September 2025. This is a normalized figure and shows they are accounting for these future cleanup costs. The company uses derivatives to hedge against price fluctuations, which we saw reflected in their income statement. As of the 30th of September 2025, they reported derivative assets of about $62 million and derivative liabilities of about $4.5 million. This net positive position indicates their hedging strategies are currently favorable on paper, but as we mentioned before, this can change. A notable detail here is their use of swaptions, which are options to enter into swaps. These are classified as level 3 fair value measurements, meaning they are harder to value and involve more estimation. The fair value of these swaptions represented a derivative liability of $2.8 million. Managing these complex instruments is always a key area of focus for companies in this sector. In terms of employee compensation, they recorded $10.8 million in stock-based compensation expense in the third quarter of 2025. This is fairly standard for a company of this size and indicates they are using stock awards to incentivize their employees. Looking back at their share repurchases for the third quarter of 2025, they bought back over 1.5 million shares for an average price of around $34 per share. This aligns with their stated strategy of returning value to shareholders. Let us revisit the sales figures. The company is a major player in the Appalachian region, and their sales of natural gas, NGLs, and oil are critical. For the 9 months ending the 30th of September 2025, these sales were over $2 billion, a significant 31% increase from $1.5 billion in the same period of 2024. This surge is driven by strong price increases. Despite the revenue jump, their total production in MACV measured in equivalent barrels of oil actually saw a modest 2% increase for the 9-month period. This means a good chunk of their revenue growth is coming from higher prices, not necessarily a huge surge in output. And this is clearly visible when you look at their average realized prices, excluding derivative settlements. Natural gas prices jumped 51% in the third quarter and a massive 72% for the first 9 months. Oil prices, however, saw a decrease of 15% in the third quarter and also a 15% drop for the 9-month period. NGLs also experienced a slight price decline. This highlights the volatile nature of commodity markets and how different products within the energy sector can perform very differently. Their costs for getting their product to market also saw some shifts. Transportation, gathering, processing, and compression expenses were $301 million in the third quarter of 2025, slightly down from $306 million in the prior year quarter. For the 9-month period, these costs were $911 million, up from $878 million in 2024. This increase is attributed to higher NGLs volumes and electricity costs. Depletion, depreciation, and amortization, or DDIR, as it is known in the industry, was $93.8 million in the third quarter. This represents the cost of the natural resources extracted over time. Interest expense decreased to $24.3 million in the third quarter, compared to $29.3 million last year, primarily due to lower debt levels. Now, no financial report is complete without a look at the risks. Range Resources lists risks related to commodity prices, geopolitical events, and regulatory changes. They also highlight the volatility of natural gas, NGLs, and oil prices as a key concern. Their strategy to manage commodity price risk relies heavily on derivative contracts, which we have already seen are having a significant impact on their reported income. They are at risk if their counterparties default on these contracts, which could limit their ability to benefit from price movements. On the interest rate front, they appear to be in a relatively stable position. The majority of their debt is fixed-rate senior notes, about $1.1 billion. Only about $129 million is on a variable rate credit facility. A 1% increase in interest rates would only add about $1.3 million in annual interest expense, meaning they are not overly exposed to rising interest rates. Their internal controls and procedures for financial reporting are deemed effective according to their management. This is a standard disclosure, but important for investor confidence. And finally, it is worth noting their ongoing share repurchase program. At the 30th of September 2025, they still had about $839.5 million available for repurchasing their own stock, signaling a continued commitment to shareholder returns. So what is the big picture here? Range Resources is demonstrating a strong rebound in its core business. Their revenues are up significantly, driven by surging commodity prices, especially for natural gas. They have managed to pay down some debt and have a very healthy balance sheet overall. The massive drop in cash on hand initially looks concerning, but when paired with their debt management and significant investments in property, it suggests a strategic deployment of capital rather than a cash crunch. Their reliance on derivative instruments to manage price volatility is evident, and while it boosted their income this quarter, it also introduces complexity and potential future risk. The company is successfully navigating market challenges and seems to be in a good position to capitalize on favorable commodity prices. However, the ongoing volatility in oil prices and the complexities of their derivative hedging strategies are areas to watch closely. They are investing heavily in their future production and actively returning capital to shareholders, which are generally positive signals for the company's direction. Alright, that is our deep dive into Range Resources' latest financial report. What are your thoughts on these numbers and what they signal for the company's future? Do you think their strategy is sound, or are there any red flags we should be more concerned about? Drop your insights in the comments below if you found this breakdown valuable. A quick like goes a long way in helping us create more content like this. And of course, subscribe so you do not miss our next analysis. And do not forget to join our growing community on Discord. All the details are in the description. Thanks for watching, and we will see you on the next episode of Corporate Decoder.